The bailouts in 2008 were a huge problem. An even bigger problem was the government intervention into financial markets, banking in particular, and even more specifically through Fannie Mae and Freddie Mac into the housing markets leading up to 2008, which is, of course, what caused the bubble, the overextension, the crash, and the ensuing Great Recession. And in similar fashion, we need to avoid too much government intervention today. That means that we need to allow banks to fail. I don't think that we're in a serious risk right now of so much bank failure that it's going to tip us into a recession. I think we've got a recession coming anyway, but I don't think it's going to be led by bank failures. Nor do I think, by the way, whether we bail out big or small banks or not is going to be the turning point issue for central bank digital currencies. The Fed is pushing this come hell or high water, whether a certain number of banks fall apart or not. I don't think that they need the excuse of giving people a way to have a direct account with the Fed. Indeed, that won't be the first way that they roll this out. They're going to roll it out to institutional investors, to banks first. It'll be wholesale long before it goes retail. We need to head that off pronto. It is a huge problem, not only because it is a spy currency, as someone said. I love that phrase, by the way, but also because it would undermine the competition for the types of currencies that we want to take hold in the United States using blockchain technology, whether that's Bitcoin or one of the others. We are within a few years of reaching an inflection point at which our economy is going to see a real burst of activity in terms of smart contracting. And we want digital currencies that are independent of the Federal Reserve System ready to rock and roll when that happens. And I'm afraid that the Fed getting into it would undermine the competition for that to work as well as it could.